Hey, Rock Daniels here. Just wanted to talk to you about the economy in Lexington, Kentucky, because it's in a precarious position right now with looming financial issues and the potential for a $45 million deficit next year. Now, the city's unfunded pension obligations, heavy debt, and misuse of funds have caused it to receive a D rating for its fiscal health from some think tanks. Now, while the city received over $100 million in federal American Rescue Plan Act or ARPA funds during the pandemic, much of it was spent on non-essential projects like parks and trails. Now, in the following analysis, I'm going to discuss the current economic situation in Lexington, Kentucky, and examine historical data to determine the impact of similar circumstances on other cities in the past. Now, I'm also going to provide a bleak outlook of the future of the Lexington economy. I'm going to explain why businesses and companies will no longer come to this city given the latest news. Now, finally, I'm going to analyze the effects of the raising of payroll taxes on businesses, laying off of city workers, and obtaining bonds at extremely high rates. Now, first off, we're going to analyze some of the other data. Now, the financial situation right here in Lexington, Kentucky, it has become increasingly alarming in recent years. Now, while the city's economy is diverse, it is not immune to the effects of the pandemic. Now, the heavy debt, the unfunded pension obligations, and financial mismanagement have created a significant issue for Lexington. Now, according to a think tank, the ratio of liabilities to liquid assets was enough to give Lexington a D rating for fiscal health. Now, the situation became more complicated when the city faced a potential $45 million deficit this next year. Now, while the city received over $100 million in American Rescue Plan Act or ARPA funds, the funds were not entirely utilized in addressing the critical issues that the city is facing right now. Now, the city allocated funds to parks and trails, which is not essential for its critical time right now. They're great for kids, but not for this. Now, the historical data from other cities have faced similar challenges and they have struggled to recover. For instance, let's look at Detroit. They faced bankruptcy in 2013 over a significant budget deficit. Detroit's financial mismanagement caused it to struggle to pay its employees, to maintain basic services, and as a result, businesses and companies stopped investing in the city. Now, this led to further financial difficulties. Now, the situation in Lexington is not very different from that of Detroit in 2013. Now, with looming deficits, businesses and companies are unlikely to invest in the city. The city's poor financial management has made it a high-risk investment, and businesses are not likely to invest, and they're going to be hesitant to come in this uncertain environment. The city's poor credit rating, along with the high risk of investing in the city, makes it less likely for businesses to come to Lexington. Moreover, the city's plan to raise payroll taxes on businesses and eventually they will lay off city workers is likely to compound this situation. Now, the proposed measures will make it more expensive for businesses to operate within the city, which may lead for them to leave the city to go to more affordable cities, even outlying cities like Georgetown. Now, layoff of city workers will lead to decrease in demand in the city, further contributing to the city's economic decline. Now, finally, the city is planning to obtain bonds, and the bonds are at extremely high interest rates, and this is going to make this financial situation in Lexington even worse. Because as interest rates rise, the city's debt service will increase, making it more challenging to service the debt. Now, moreover, the city's increasing unfunded police and fire pension liabilities make it difficult for the city to manage its finances. So guys, in conclusion, the situation in Lexington, Kentucky is alarming. Let's look at this $45 million deficit and poor credit rating. Looking at historical data from other cities, we are going to face similar challenges. All right, so we got to study the history. The city's poor financial management and allocation of funds to non-essential projects are likely to deter businesses and companies from investing in the city and getting us out of this debt. Now, the city's plan to raise payroll taxes on businesses, they're probably going to lay off city workers. They're going to obtain bonds at high interest rates. It's going to place Lexington in a precarious situation, especially when